Testamentary trusts, which are trusts created by the will of a deceased parent, receive a portion of the estate or other proceeds, investments, and they generate trust income. And clients often ask, well, should we be using the qualifying disability trust election? If the beneficiary of a testamentary trust qualifies for the disability tax credit, then the trust can elect to be a qualifying disability trust, and then it can still fall under the old rules where the income of the trust is taxed at beginning marginal rates of 22% and 33% and 44%. But of course this means that the trust will be paying tax at a reduced rate, but still paying tax. So a better procedure is, if the child qualifies for the disability tax credit, to make use of the preferred beneficiary election. So instead what you do is you elect to attribute the income to the child. So the trust starts out with income and then elects to attribute it and has a zero return each year, a nil return. And this income is then reported on the tax return of the child, the beneficiary, and they have personal tax credits and disability credits totaling $20,000. So the first $20,000 of income is not taxed. And then, if you continue to attribute, they too have income taxed at the lowest marginal rate, 22%, on the first $45,000. So this means the first $65,000 of income is dealt with. If you're in a position where you have so much trust income that you're then pushing into the 33% bracket, then you might decide to elect to have the trust a qualifying disability trust, declare that proportion of the income in its hands at 22%, and save 11% on that amount of income. So you can see it's a diminished return. This procedure is not complicated, and we have a case right now where it was not done. The clients are new clients to us, but old clients. The parent died more than 10 years ago, but the accountants didn't make use of this alternate arrangement. So we're now in the process of calculating how much taxes the trust did pay, and then back-filing for 10 years to readjust this. And obviously, if you save approximately $3,000 in taxes each year for 10 years, this is worth doing. If you have questions, feel free to contact me.